Taking myself for example, I don't want to stay in a trade for too long. I'm someone who is impatient sometimes, right? I want to see my results. I want to see if it's a winner or a loss. That's why scalping is very, very popular when it comes to Forex trading. You can easily get in and out of trades while making a lot of money. That's why as a beginner Forex trader, you guys are confused. You've seen all these videos from these gurus confusing you here and there. And on this video, I want to do it in less than 10 minutes and give you a scalping strategy that you can start practicing it after this video to make money in Forex trading, guaranteed. If this is your first time watching my video, my name is Ndemazeah Godlove. I do videos about Forex trading, business, travel, crypto, and tips to help you stay profitable on a consistent basis. I have the biggest Forex community in Africa, and if this is your first time watching, make sure you smash the subscribe button below to subscribe to the channel. So what's scalping? So scalping is a trading style where you get in and out of a trade within seconds to even minutes. All right, so if you're holding your trades more than 30 minutes, you're not more a scalper. Any trade which is a scalping, which is a scalp, is between seconds up to 30 minutes. 30 minutes you're already done for the day, or you're already done for that particular trade. You can have multiple scalps in a day. All right, so that's scalping in a nutshell. When it comes to trading, we have different styles of trading. We have scalping, the trading, swing trading, and position trading. So we're focusing on scalping, on the adrenaline rush. We want to know the results. We want to know if we're making money or not. So come with me to my screen, and I'm just going to quickly show you guys a scalping strategy that you can start using it to make money after this video. Perfect. Scalping strategy is simple. Remember, I want to keep this video as short and as simple as possible so that you can be able to spend more time practicing. We need a tool that will help us to be able to determine our trend. Remember, I'm assuming you are a beginner and you're not too experienced with Forex trading, though even experienced Forex traders can still do it this way. So you need a tool, and this tool is an indicator. I don't rely much on indicators because indicators are more like lagging tools. But one that is very, very effective is a moving average. Even coming to a moving average, there's a way I fine-tune it to fit my style of trading, which makes it not too lagging. And that is how I'm able to make money with scalping. First thing, you need two moving averages, which are supposed to be exponential moving averages. All right, make sure you take down these points. It has to be just this way. Two exponential moving averages. The first moving average, as you can see on my screen, is this blue moving average. Oh yeah, this should be blue, right? Is this blue moving average, which has a period of 10. So I'm just going to go there. I just right click on it. I right click. I go to properties, and to add an indicator on your computer is easy. Just go to where it says indicator, then you go to where it says moving average, drag and drop on your computer, and then you see this screen which is going to open. On that period, make sure you put the first one is 10. A method is exponential. Don't use simple, linear, aggravative, additive. There are many moving averages method. Best exponential. We want to filter all the fake signals, right? Good. So put exponential, and even after that, something you only hear on Ndemazeah's Godlove channel, something you only hear on this channel is applied to. This is more for people who are very, very experienced with statistics. You know, with statistics, when it comes to correlation and the Sharpe ratio, the smaller your Sharpe ratio, the more effective your results are going to be. So the median method tends to use a very small Sharpe ratio. That's why if you come here where it says applied to, don't use the close price, because the close price is just going to be the same price which is going to be applied on your screen. But if you use the median price, remember the indicator is going to be looking for the median price where they can say, okay, this is an uptrend or a downtrend. So that will tend to filter out a lot of fake signals. That's very, very important. So apply to, make sure you choose median, and then the 10 moving average, put it on a 10 exponential moving average, apply to median, put the color on blue, and you click on OK. Voila, you see the moving average is going to be this blue one, and the smaller the moving average, the faster it's going to be. So the blue moving average is what? Is our faster moving average, the blue 10 exponential moving average. Then we'll go to the next one here, which is what? Which is our 23 moving average. We'll just go there again. I want to just show you guys the properties. Okay, let's just go here. I want to make sure it pops up. Okay, perfect. Properties, good. Under the next moving average which we need a 23 moving average. Apply method again is applied to median. Method is exponential, the same thing, just the period is 23, color is red, and you click on OK. If you click on OK, now we have two moving averages on our screen. Where do we enter the trade and where do we exit the trade? We enter the trade where the fast moving average, which is the blue moving average, crosses over the slow moving average, which is the red moving average from below. So from my explanation, you can see this was a buy trade right here. This was where we had a potential buy trade, all right? Because you can see the blue moving average crosses over the red moving average from below, or the fast moving average, which is the 10 exponential moving average, crosses over the slow moving average, which is the red moving average, exponential moving average from below. That's a typical downtrend, and you can see from there to wheresoever we have another trend, that's almost about 1,500 pips. This is the 4-hour time frame. Remember, this is going to be scalping, and on scalping, this is what I want you to do. I want you to have it on the 4-hour time frame to determine the macro trend, and then go down to 5-minute time frame to place your trade. So on the 4-hour time frame, I want to be able to confirm the moving averages are aligned in an uptrend or a downtrend. All right, good. Remember, if the same thing, the opposite happens up here, where the fast moving average crosses over the slow moving average from above, going below, that becomes a sell signal. So we obviously have a sell signal somewhere here. So this would have been a sell signal somewhere here, where the blue moving average crosses over the red moving average from above. All right, it's indicating that the sellers are in the market. It's indicating that supply is more than demand. Good. So use 4-hour time frame to determine the macro trend, because we want to only trade in the direction of the market, right? And then after, you just click. Now let's just assume I wanted to trade from the 19th of February, right? So let's just put this mark somewhere here, and that day I come to the 4-hour time frame, and I plot in my moving averages, and I can already confirm there was a cross here, and at that point in time you see the two moving averages align. All right, the red one below and the fast one above. That's confirming what? An uptrend. What will I do again? I just click now on the 5-minute time frame. I click on the 5-minute time frame, and if I have to go to that 19, okay, this is the 15. Let's just keep going to the 19. I want to show you what was happening now on the 5-minute time frame, which is what you have to pay attention. All right, let's just keep going. Perfect. So I can already start seeing something here. Let's just keep going closer to the 19th of February, which was when we had that trend, right? I want to show you how you can then scalp on the 5-minute time frame. It's as easy as that. And there are still some points you need to note. Which market sessions are you supposed to trade this strategy? Because if you are trading it during all market sessions, there are some market sessions like the Asian session or the Australian session where the market is dead. You're just going to be losing your money. So I'll also talk about market sessions where you can actually trade this particular strategy. Very soon I'm going to get to the 19, or I'm going to get to the area where we actually had that mark, right? I'm going to get to the area very, very soon, so that I can be able to show you guys actually what happened. Good. Let's just keep going. Perfect. I can be able to see it right here. Good. So remember, we're going to still have this line somewhere here, just to extrapolate this area, because the same area we extrapolated on the high time frame is this same area somewhere. The same area you're seeing here. So on the higher time frame, what was our overall trend? Our overall trend was an uptrend. So we already have that noted down, that the overall trend on the higher time frame, which is the 4-hour time frame, is an uptrend. Lower time frame, we're going to be trading only in that particular direction. Remember, when we came into now 5-minute time frame, it was telling us otherwise. The 5-minute time frame was doing what? Was instead telling us that it's a downtrend somewhere here. You can see the market crossed, and it was instead the slow moving average was above the fast moving average. The red was above the blue, meaning the market was actually selling. You can see. So the market can be buying on one time frame and selling on one time frame. It's very, very normal, because remember, on the 4-hour time frame, you have confirmed that the market is in an uptrend. But a small candle which has just retraced a little bit on the 4-hour time, just a small retracement on the 4-hour time frame, can be a completely opposite trend on the lower time frame. A small retracement on An uptrend on the 4-hour time frame can be a whole downtrend on the 5-minute time frame. That's what I want you guys to be able to understand. So at that point in time, I just come here and I already confirmed that the market is instead going contrary to the overall trend I have in mind. So what am I waiting? I'm only waiting for the trends to align. I'm waiting for both the 4-hour time frame and the 5-minute time frame to align. As easy as that. So I'm just watching. Remember, this is a 5-minute time frame, so things are going to be fast. I'm just watching, and boom, somewhere here, exactly what we've been talking about, the same thing happened. You can see the fast moving average, which is the 10 exponential moving average, crosses over the slow moving average, which is what? The 23 exponential moving average from below. That is a buy signal. Perfect. At that point in time, remember the candle is going to close somewhere here. The candle is going to be closing. By the time I confirm the cross, this candle is going to be closed somewhere here. So voila, what will I do? I just get into this trade somewhere here. My stop loss is going to go, remember, I go for a risk to reward of 1:3 when I'm trading with this star and I'm out. So I just go here. I can put my stop loss just about 5 pips, 5 to 6 pips. Remember, this is scalping. So my stop loss can go somewhere here. Just somewhere here. Look at this. I'm going to show you guys this, and then I'm going for a risk to reward of 1:3. Meaning, if I'm risking 6 pips, I'm going for 18 pips. So from our point of entry, if I can extrapolate 18 pips, this is 18 pips somewhere. Voila, we're out. This is 18 pips somewhere here. Can you see this? This is 18 pips. So from here right up to here, we've already made 1:3, a risk to reward of 1:3 on our account. If you are risking $100, we've already made $300. We're risking $1,000, we've already made $3,000. For those who are trading prop firms, if you are risking 1% on a $100,000 account, you've already made 3%. That's 3% of your account. Very soon you're going to pass. We take it down, that's plus 3%. How do you re-enter the trade? You re-enter the trade as soon as the market pulls back to what? To the fast moving average and gives you a buy signal, all right, and gives you a buy candle. As soon as the market pushes back to the fast moving average, which is the 10 exponential moving average, or between the fast and the slow moving, so the market can still get in between here, it will still be a valid signal. As soon as you get down the first blue candle, voila, we are going in, bro. So I'm gonna get in again somewhere here. My stop loss will just go below that swing, so I'm gonna get in somewhere here. My stop loss is just gonna go somewhere here on 4 pips. And remember, I'm going for a risk to go on 1:3. I'm targeting 12 pips. 12 pips is right here. Let me see this. Can you see this? Voila, 12 pips is right there. We are out of the trade. 6% done for that day. And remember, this is just from around 8 a.m. to about, we are still here on around 10 a.m. We haven't even been trading for up to 2 hours. But we've already made 6% of our account because we know what we are doing. Good. At this particular point in time, you see the market continues shooting up. So you can't do anything because the market hasn't respected that our rule. The market only respected the rule again somewhere here when it pushed back again to the fast moving average, or between the fast moving average and the slow moving average. And we had the first buy signal, which was here. So we would have gotten in again where? We would have gotten in again somewhere here. Stop loss again just below the swing. So this one would have been a bigger stop loss. Our stop loss would have gone somewhere here on 10 pips. So we would have risked 10 pips on this particular one. And if we are risking 10 pips, remember our risk to reward is 1:3. We are going for 30 pips. So did we hit our target? Let's see. Boom. We hit our target. This is where we hit our target right here. 30 pips, we hit our target. That's 3% of our account again. And what happened? We are already out. That's 9% in one day. 9%. You guys, there are sometimes I've shared screenshots making 15% of my account. Remember, you're doing this on multiple pairs. There are going to be times where, or you guys have seen times where I've shared my screenshot making 15%, 18% in one day. It's not magic. This is it, bro. Just practice this religiously. You're going to get the same result. It's as easy as that. Now, this is where we would have gotten our first loser, right? I can already see something here. We got out of the trade here, and according to our rule, we wait for the market to push back to the fast moving average, or between the fast and the slow moving average, and give us the first bullish signal, which is the first blue candle. So that happened right here, this candle right here. So we would have gotten in on this one right here. And if we can measure the risks on this one, our stop loss would have gone somewhere here on 7 pips. So we would have been risking 7 pips on this one and going for 14 pips. So let's go to the right to see if we would have hit our take profit. We would have hit our take profit before the New York session. Remember, we're doing all of this during the London session. See what happened. See what happened. See what happened? We got in here, we're risking 7 pips, and we're going for 14 pips. 14 pips was just somewhere here, risk to reward of 1:3. Boom, we're out of the trade. That's how much again I've even lost count. So that's like 12% of our account in one day. Even in one market session. One market session, we've already made 12% of our account. Watch what happened. Immediately we got out of the trade, then wait again for a pushback. We would have gotten in somewhere here, risk again about 8 pips again and go for 16 pips. 16 pips was here, boom, would have hit it again. That's another 3 pips. That's another 3%. That's 15% of our account in one day. Now, this is where the loss would have come in, right? Remember, we got into this trade somewhere here, and according to the rules, you wait for the market to push back to this, the fast moving average, or between the fast and the slow moving average, and then you take your trade and wait for the first bullish signal to take your trade. This wouldn't have been a loser because that didn't even happen. By the time the New York session, this is New York. If I click here, you see that was exactly 3:30. The New York session used to open by 3 o'clock, 3 p.m. my time, and news comes out most of the time by 3:30. So this happens 3:30. I already know the market is going to shoot like this, particularly on USD pairs. It's going to shoot like this in one direction. So this happened. You can already see crystal clear, the market push again in the opposite direction, and at that point in time we wouldn't have taken any trade because you can see what happened. The trend is now violated. Remember, the bigger picture in our mind is what? It's an upper trend, on the higher time frame. Now you can see the fast moving average has crossed over the slow moving average from above on the lower time frame, meaning on the lower time frame, the lower time frame is not more syncing, it's not more in synchronization with what? With the higher time frame. So at this point in time, we're like, oh, let's sit and watch and see what happens. So this was in the 5-minute time frame, and all of this happens on the 5-minute time frame, and on the 4-hour time frame, it was still a bullish signal. It was still a bullish signal. So from here to here, I didn't take any trade because I would have started looking for sell opportunities if the candlestick again changes. If on the 4-hour time frame, I'm going to quickly show you this. If on the 4-hour time frame, we confirm this same setup somewhere here, where now what happened? The fast moving average crosses over the slow moving average from above. That's where I would have started looking for sell opportunities on the lower time frame, because I have confirmed that on the higher time frame the market is also selling. So I know that the bigger fish, the hedge funds, the banks, they are now in the bearish direction. So let me only be bearish on that particular trade. So I've just used the buy scenario to explain, and not to make the video so long. You just do the same thing for the opposite. If it's a sell trade, you make sure on the higher time frame you've confirmed with the moving averages that the market is actually selling. Once you've already confirmed that the market is selling on the higher time frame, on the lower time frame, which is the 5-minute time frame, you are only looking for what? For sell trade. So for sell trade on the lower time frame, this is what is going to instead happen. On the sell trade, let's just assume, okay, let me just look for a sell opportunity and show you guys what I'm talking about, right? Let me look for a typical example that can make things very, very clear. Good. This is still a buy opportunity. This is still buy. Remember the whole of this is this box we have somewhere here, which was confirming we're going to be having a sell opportunity somewhere. Okay, you can see. So the box we just saw was the same box we had on the 4-hour time frame. So let's just assume on the 4-hour time frame we had a sell setup. On the lower time frame, we're all going to be looking for sell opportunity. So we came here this day, this line you are seeing, the market was instead what? On an uptrend on the lower time frame. You can see the blue moving average and the red moving average are all shooting up, with the blue moving average above the red moving average, confirming an uptrend. So at that point in time, boom, I can put my PS. That's why most of the time I put my PS, I'm playing PS, or I'm having live sessions, or I'm doing other things, waiting for what? Just waiting for the trend to align. And boom, behold, the trend aligns somewhere here. This is where the trend aligns, where the faster moving average instead crosses over the slower moving average, which is the 10 moving average crossing over the 23 moving average, or the blue moving average crossing over the red moving average from above, confirming what? A downtrend. So voila. So long as I already have this confirmed, this crossing would have been somewhere here. The close of the candle would have been here. So I believe we would have gotten into this trade somewhere here. Remember, I've already confirmed again on the high time frame. We would have gotten into this trade somewhere here with a sell. Put our stop loss where? Our stop loss just go below this swing, or somewhere here. We would have been risking about 6 pips to go for 12 pips. Voila, we are already out. We are already out of the trade somewhere here. And then what do you do again? You just wait now for the market to push back to the slow, wait for the market to push back to what? To your fast moving average, or between the fast and the slow. So it's the same thing. The market should push back to your fast moving average, or between your fast and your slow moving average, and then produce the first red candle. At this particular point, the market needs to produce the first bearish candle, since you are looking for a bearish opportunity. So that happened exactly somewhere here. When we got out, the market pushed back somewhere here, and this is the first bearish candle we had. So we would have gotten into a sell somewhere here, and then just put our stop loss just below this swing somewhere here, just below the swing. So we would have been risking about 4 pips, and then we go for what? 12 pips, which now you would have seen this one would have been a loss, because 4 pips would have just been somewhere here. So this is actually our first loss, you see. So 4 pips would have been here. We got in somewhere here at the close of this candle. So the market would have just pushed like this, boom, in our opposite direction, strike us out on 4 pips before even continuing on our original. That this is going to happen many times. Just normalize this in the forex market. This is going to happen many times, where the market goes in the opposite direction, trigger you out of your position, and then just continue going in your original direction as if nothing has happened. I know that sucks, but you're going to see this in the forex market as many times as possible. So this one would have already been a loss, and as soon as we were triggered out of the trade somewhere here, what were we going to do again? We'll wait for the market to push in our direction, then push against us again, produce the first again bearish signal. So the first bearish signal would have again somewhere here. So I think this one would have been a loss again because of these swings we had, unless you were using flexible stop losses. So the next bearish candle would have been here. We got in with a sell somewhere here. Our stop loss would have just been somewhere here, and we got triggered out again. So another thing you can do is you can give a little bit of flexibility, because if you give a little bit of flexibility and put your stop loss on 8 pips, and you are going for 8 times, and you're going for 24 pips, you would have gotten out of the trade somewhere here, and your trade would have been safe. You just keep doing that. Just keep the same thing. If it's a sell trade, just wait for the market to push in the opposite direction, which is that retracement. You wait for the market to break in the opposite direction to the fast moving average, which is the blue moving average, or between the fast and the slow moving average, and then produce the first red candle, and you buy. As soon as that first red candle closes, you place a sell position, your stop loss goes above that particular swing, and then you go for a risk to reward of 1:3. Do this conservatively for a day. Use a sample size of 20 trades, and come back to me and let me know your results. And this is going to baffle you for life. Do this, guys. Do this religiously for a day. Do it on gold. The best currency pair that will work is on gold, Great Britain Pound USD, Euro USD, or Great Britain Pound JPY. USD JPY is also very, very awesome. Or in a currency pair, just practice this and you're going to see marvelous results. Remember, I was talking about market session. You only trade this strategy during the London or the New York market session. No other session. Only trade this during the London and the New York market session. In South Africa, my time, the London session starts by 8 a.m. my time. So 8 a.m. I'm already at the office. I can start trading, and then it goes up to the New York session open by 3 p.m. my time, and then it closes by right up to about 6 p.m. or 5 p.m. my time. So I can trade by the open of the London session right up to the open of the New York session, right up to the close of the New York session. So you can trade throughout this entire market session, not just when the two market sessions have overlapped. No, throughout the entire market session, both the London session and the New York session, because those are the two most volatile market sessions. And we need the market to be volatile, because where there's volatility, there is liquidity. You want to trade where there's actually liquidity in the market, so that we can be able to make that money. So I hope you guys have gotten a lot of tips from this particular video talking about the same strategy. I got a Forex robot which has gotten a lot of award, which is known as Perps Pro. Perps Pro has a tool which will be able to analyze all time frames from the 1 minute time frame right up to the 1 month time frame within 2 seconds, combined with AI, to give you exactly what is happening on those time frames. So what you can do is just to watch on your screen. You just put Perps Pro on your screen. Let me show you guys just a quick example of what I'm talking about. I'm just going to drop Perps Pro on my computer. That's it. I click on OK, and within a couple of seconds, you can see what's happening on my screen. Perps Pro has already given me a signal. Perps Pro has analyzed from what? From the 1 minute time frame right up to the 1 month time frame. I can see everything that is happening on this particular time, on this particular currency pair. I'm talking about gold based on the strategy I was explaining. You need to confirm gold is on the same direction on the high time frame as on the lower time frame. On the high time frame, which is the time frame of reference, what did I say? A 4-hour time frame. On the 4-hour time frame, you can see the robot says now buying. On the lower time frame where we're going to be taking our trade, what does it say? It says here again, now buying. So that's a pure confirmation. So what we would have done now is, let me show you guys. I'm just going to show you guys really quick. Let's just go to where the market is now, because I've already confirmed on the high time frame, the market is in an uptrend. I've already confirmed on the lower time frame, the market is also on the same direction. So let's just go here to where the current market price is now, and you'll see what I'm talking about. This is the 5 minute time frame. We have this cross somewhere here, and we can as soon as this candle closes as a bullish candle, so we're just waiting to see what's going to happen with this candle. If the candle closes as a bullish candle, then we're going to enter our first buy trade. If the market push back, remember this is what? This is our fast moving average, which is the blue candle. So if the market closes somewhere here, the next blue candle we see, we're going to be taking a buy trade. Or if it continues pushing down, even between the blue and the rest, the next blue and the red, the next blue candle we see, we're going to be taking a buy trade. Our stop loss will just go below that particular swing, because by the time the market is producing a blue candle, there will be a swing. So our stop loss will just go below that swing, and we'll go for a risk to reward or 1:3. Boom. We just keep doing that while watching what is happening here, until I'll keep looking for buy opportunities on the lower time frame, until on the 4-hour time frame I see here that now selling. Until I see on the 4-hour time frame that now selling, then I'll only go on the 5 minute time frame, and I start looking for what? I start looking for sell opportunities. So if you want to use a tool like this, which will also help you to analyze the market, and there's an option where you can just turn it on for the robot to be able to use this to trade, to automatically trade for you 100%. Automatic, 100%. You place, it does everything, it trades for you. So that's the reason why this robot has won multiple awards as the best Forex robot, best mechanical automated Forex robot powered by AI. You can see just as we are speaking, the robot is already opening trades. So let's just go to our trading terminal, and boom, can you see this? This is my small life account, which is my small $1,000 account. As we are explaining, the robot has already done all the analysis on all the time frames and opened the two trades. So if you want to use Perps Pro, just check the link on the video description, and it will take you to the website. And if you want to get it today, I will give you a 10% discount. So just use the code on your screen, Millionaire10, all right? Millionaire10 to get 10% discount off from Perps Pro. Click this video to watch a video which I made explaining more or showing you guys more live example, making almost about $40,000 using the same strategy I've just shown you guys. And also click here to subscribe to the channel if you haven't done so. Check the link on the video description to use the best prop firm line hard funding program, or to use my recommended broker, and I'll see you guys on these other videos. Peace.